Welcome to our latest episode, Tax Compliance for U.S. Entrepreneurs in the UAE. In this episode, I'm going to be talking about the tax challenges facing Americans doing business in the UAE. Recently got a couple of new clients who are both highly successful U.S. entrepreneurs and business owners in the UAE. I wish they would have come to me sooner because their situations are a mess, which is sad because both of these clients wanted to do things right. They weren't negligent, flying by the seat of their pants. Rather, they hired well-known U.S. international tax advisory firms who advertise they are U.S. international tax experts. Unfortunately, they're not. Many of the U.S. international tax compliance companies are better at marketing than advising. But anyway, that's not the point of this episode. The point of this episode is to educate Americans doing business or contemplating doing business in the UAE on how they're going to be taxed. To start,
welcome to the Wealth Uncensored podcast. Straight talk about everything that impacts your wealth. In each episode, I share what I've learned through my own experience and 2 decades of helping high net worth clients structure their affairs to minimize taxes and protect their assets for the next generation. I'll also feature special guests who are experts in their own field, sharing their knowledge and experience to help you protect what's yours. I'm your host, Jimmy Sexton. Let's dive into today's show.
To start, just a quick primer on UAE income taxes. The UAE has no personal income taxes. The UAE does, however, have a 9% corporate income tax rate that applies to local companies and free zone companies, as well as self-employed individuals. There are certain exceptions to the income tax, but that is beyond the scope of this episode. Let's first talk about Americans who are self-employed in the UAE. You're going to be liable for a 9% corporate income tax on your self-employment earnings. You're also going to be liable for U.S. income taxes up to 37% and self-employment taxes of 15.3%. The 9% corporate income tax rate that's payable in the UAE can be used as a foreign tax credit against your U.S. income tax, but against income tax only. You can't use the foreign tax credit to offset self-employment tax. Alternatively, you can opt to use the foreign earned income exclusion and exclude up to $126,500 of your self-employment income. But remember, the foreign earned income exclusion can only be used to offset income tax, not the 15.3% self-employment tax. You're going to have to pay that regardless of whether you use the foreign tax credit or the foreign earned income exclusion. What happens if you own a mainland or a free zone company in the UAE? How you're taxed if you own a UAE company. Now, in the UAE, there's 2 different kinds of companies, right? You have mainland companies, which are essentially allowed to do business throughout the UAE. And then you have free zone companies, which are only allowed to do business in the free zone. Now, free zone companies have always been able to be 100% owned by foreign nationals. Mainland companies, on the other hand, have generally required there be a local sponsor, right? So a UAE national that owns at least 51% of the mainland company. Now, they've since abolished this rule and 100% foreign ownership of mainland companies is permitted, but that hasn't always been the case. So there's a lot of Americans that set up companies where they had a local sponsor that owned at least 51% of the mainland company. And one of the mistakes that I've commonly seen is that they've treated that 51% as actually being owned by that local sponsor, which in my opinion is absolutely incorrect, because in most cases, that local sponsor just got a flat fee for lending their name and being the local sponsor, right? It's really the American that owned and controlled the company, right? He was just owning it through this local sponsor. So in my opinion, if you used a local sponsor to set up a mainland company, that local sponsor that you used is a nominee, right? You're still the beneficial owner of the shares in that mainland company owned by the local sponsor. Let's say, for example, you're an American, you set up a mainland company, and on paper you own 49% and the local sponsor owns 51%. It's really beneficially owned 100% by you, right? So for U.S. tax reporting purposes, I would treat that mainland company as 100% owned by that US citizen that on paper owned 49%. I would treat the 51% owned by the local sponsor as also owned by the American that owns the 49% and treat them as beneficially owning 100% of that mainland company. This obviously can come with some drawbacks. The reason being is that companies more than 50% owned by US shareholders are treated as what's called controlled foreign corporation. And US shareholders of controlled foreign corporations are required to pay income tax on the profits of that foreign corporation, the UAE corporation, regardless of whether or not they actually receive it. A lot of people prefer to try to treat it as not a controlled foreign corporation, claiming they really only own 49% of the mainland company and the local sponsor owns 51%, because that makes it not a controlled foreign corporation because it's not more than 50% owned by US shareholders. And therefore, the US citizen would only be paying tax on actual distributions or compensation received from the UAE mainland company rather than on the profits of the UAE company, regardless of whether or not they actually received the profits from the UAE company. But I don't think that that's correct to do, right? I think you have to report it based on the beneficial ownership. So if you're an American, you have a local company, you have a local sponsor, you have to treat the shares owned by the local sponsor as being owned by yourself as the beneficial owner, which would likely then turn the mainland company into a controlled foreign corporation. You'd be liable for taxes on the profits of that foreign corporation, regardless of whether or not you actually received it. So just to recap, controlled foreign corporations are foreign corporations that are more than 50% owned by US shareholders. So whether you have a mainland company or a free zone company, if it's more than 50% owned by US shareholders, it's going to be treated as a controlled foreign corporation, and you're going to be liable for tax on the profits of that controlled foreign corporation under either subpart F or guilty, regardless of whether or not you actually receive the money from the company. The benefit is when that company does eventually pay a distribution to you, it's going to be considered previously taxed income, and you're not going to pay tax again because you already paid tax on the profits in the company. One of the downsides, however, of doing business through a foreign corporation is that any losses are stuck in that foreign corporation and can't be used to offset other income. Also, as I mentioned earlier, the UAE does have a 9% corporate income tax that if you, like a self-employed individual, if they pay that corporate income tax of 9%, they can use that to offset their US taxes as a foreign tax credit. That isn't possible if a foreign corporation, a UAE corporation in this case, pays that 9% corporate income tax. The corporate income tax stuck in the corporation for tax credit purposes. Another one of the downsides is that capital gains are transformed into ordinary income. So let's say, for example, you owned an asset directly, you owned it for more than a year, so it would qualify for long-term capital gain, and then you go to sell that asset, you're going to have a maximum tax, a long-term capital gains tax of 20% in the US. If you own that asset through a company, though, the company is going to recognize the gain, and the only way for you to get that gain is through a dividend, or it's going to be attributed to you under subpart F or guilty, and you're going to pay ordinary income taxes on it. So capital gains are transformed into ordinary income if the capital gain is earned through a foreign corporation. Now, one thing I do want to mention with regard to the foreign tax credit, right? So I said that if the foreign corporation pays the UAE income tax, corporate income tax of 9%, it's stuck in the foreign corporation, the UAE corporation, in this case, for foreign tax credit purposes. U.S. shareholder can make an election under IRC 962 to be treated as a corporation for purposes of the foreign corporation, meaning they would get some benefit from that tax credit. The downside, however, is that when future distributions are made, they're going to have to pay tax. Whereas if they just pay tax on the profits without regard to the foreign tax credit, they would not be liable for tax again when actual distributions are made from the foreign corporation. If you have a controlled foreign corporation, you're also going to have to file some forms for U.S. tax compliance purposes with your U.S. tax return. Most commonly, it's going to be Form 5471, Form 926, Form 8938, and filing an FBAR, the Report of Foreign Bank and Other Financial Accounts, if you're a signer on the foreign bank account or if you have a financial interest in the corporation's bank account, which you would have if you owned more than 50% of it. To recap, if your UAE company is considered a controlled foreign corporation, you're going to have to pay tax on the profits of that UAE company, regardless of whether or not you receive them. The upside, of course, is that you won't have to pay tax again when you receive an actual dividend or distribution from your UAE company. The only time you can defer taxes is if you have a foreign operating business, so a UAE operating business that is not a CFC. So let's say, for example, it is 50% or less owned by U.S. shareholders, and the other part is legitimately owned by other shareholders, then it wouldn't be a CFC, and basically you would only be liable for tax when you actually received a dividend, or of course if you receive compensation, that's always going to be taxed. Again, you will likely have some reporting requirements that you need to file with your U.S. tax return. That includes Form 5471, 926, and possibly Form 8938. Now, let's talk about some strategies that UAE business owners can use to help minimize their U.S. tax burden. Let's look at the following example, okay? We have a UAE company that's engaged in an active business, and it's 100% owned by a single U.S. shareholder. So in this scenario, the U.S. shareholder is going to have to pay U.S. taxes under GILTI on the profits of the foreign corporation, regardless of whether or not they actually receive those profits through dividends, right? So even if they don't get any money from the company in the form of dividends, they still have to pay tax on the profits of their foreign corporation under GILTI at ordinary income tax rates up to 37%. Now, in addition to the 37% U.S. taxes that they're paying on the profits of their foreign corporation, the foreign corporation itself is also paying 9% UAE corporate income taxes that cannot be used to offset the up to 37% U.S. income taxes that are being paid under GILTI. One potential structure to help minimize the impact of this is for this U.S. citizen shareholder of the UAE company to set up a U.S. C corporation holding company and transfer their shares in the UAE company to the U.S. holding company. Now, the U.S. holding company will be liable for GILTI tax on the profits of the foreign corporation, the UAE corporation in this case, but at a maximum rate of 10.5% rather than 37%. Additionally, because it's a U.S. corporation rather than an individual owning the UAE company, it will get to take an 80% tax credit for the 9% corporate income tax paid in the UAE to help offset that 10.5% paid in the U.S. And so the additional tax that would be payable in the U.S. is essentially the difference between 10.5% and 80% of 9% corporate income tax paid in the UAE. Now, another advantage is that when the UAE company pays dividends to the U.S. holding company, there will be no further tax because the U.S. has 100% dividends received deduction, which means that U.S. companies that own 10% or more of the company paying the dividend don't pay taxes on those dividends. So that's a pretty good way to reduce your taxes. And when the U.S. company eventually pays its shareholder a dividend, it's going to be considered a qualified dividend, meaning that it's going to be subject to a maximum tax rate of 20%. Now let's look at some other strategies. Most UAE companies, most, if not all, might be all, are considered what are known as eligible entities for U.S. income tax purposes. Now, eligible entities are able to elect how they want to be taxed. In most cases, when we're talking about UAE companies, the default treatment is as a foreign corporation, but they can elect to be treated as a flow-through entity, meaning all of the income flows through to the owners and the owners pay tax on the income. Eligible entities would be treated as a partnership if it had more than one owner, or a disregarded entity if they only have one owner. One of the advantages is if you have a flow-through entity, so you make the entity classification election to have the UAE company treated as either a partnership or disregarded entity, depending on if it has one or multiple owners, now it's a flow-through entity, which means income and losses flow through to the owners and the owners pay tax on the income. But the losses also flow through to the owners and the owners can use those losses to offset other income. Additionally, the foreign tax credit is no longer stuck. So the foreign tax credit would also flow through the disregarded entity or partnership and would be able to be used to offset U.S. income taxes. So let's say, for example, going back to the previous example we used earlier, you have a U.S. citizen that owns 100% of a UAE operating company that has filed an entity classification election to be treated as a disregarded entity. The U.S. citizen would be required to pay income tax on 100% of the income from the disregarded entity at rates up to 37%, but they would be able to use the 9% UAE corporate income tax paid to help offset that U.S. income tax at 37%. In this case, since it's an operating entity, you'd also have the 15.3% self-employment tax. The other advantage is capital gains retain their character, right? So if you have a long-term capital gain in a flow-through entity, it's also going to be a long-term capital gain in the hands of the U.S. owner, meaning they're going to pay a maximum long-term capital gains tax rate of 20% rather than that gain being turned into ordinary income if it was earned within a foreign corporation. You also have much simpler reporting. So rather than 5471, you'd have Form 8865 or 8858. You'd also have the FBAR in the event that you had a signature authority over or a financial interest in the bank accounts of the foreign entity. Or you can just expatriate and avoid this altogether. That makes things much, much easier. To recap, we've discussed how American entrepreneurs and business owners in the UAE are taxed, their U.S. tax compliance requirements, and some strategies for lowering their taxes. With proper planning, you can greatly improve your tax situation. Without it, you risk winding up with higher taxes and running afoul of the U.S.'s complex tax reporting with regard to foreign income and assets. And failure to comply comes with harsh penalties in the U.S. I hope you found this episode useful.
Thank you for joining me on Wealth Uncensored, where we help you minimize taxes and protect your wealth for the next generation. If you like our show, be sure to subscribe and leave a review. And if you have any questions or suggestions for future episodes, we'd love to hear from you. You can email us at info@esquiregroup.com. And don't forget to visit Esquire Group's website for more information on how we can help you secure your wealth. I'll be dropping knowledge again next week. Don't forget to join us.